Hi, welcome back to Simply Accounting. In today's video, we will do another problem that involves assets, liabilities, revenues, expenses, and capital. So let's get started. So this problem, we're talking about Myers Cleaners, and these are the transactions for the month of March. So it says for March 6th that the business purchased supplies on account for $50. So for this first transaction, you are going to debit your supplies account for $50, and then you are going to credit your accounts payable account for $50 because that is the amount that you owe your business, that you owe the business that you bought your supplies from. And then it says, on March 7th, you received cash from customers for dry cleaning sales of $1,800 and laundry sales of $700. So for this one, you are going to, For this one, you are going to debit your cash account for $2,500, and that is the total of your $1,800 plus your $700, which gives you $2,500. So you would debit that amount to cash because that is the amount of cash that you're receiving for your service that you did, and you are going to credit your service revenue account for $2,500. Okay, and then it says you on March 11th you billed customers for dry cleaning sales on account, and that amount was $590. So for this one, you are going to debit your accounts receivable account because that is the money that you have not received yet. So you're going to debit it to accounts receivable, and then you are going to credit your service revenue account for $590 because that is the amount of money that you will earn from doing your service. Then it says on March 15th, you paid the following expenses. So it was wage expenses for $250, delivery equipment expense for $70, utilities expense for $55, and miscellaneous expense for $85. So for each expense, it has its own T account, so you would debit each expense account. So for wages expense, you would debit it for $250. Delivery equipment expense, you would debit it for $70. Utilities expense, you debit it for $55. And miscellaneous expense, you would debit it for $85. So the total for all of these expenses is $460. And that is the amount that you would credit to your cash account because that is the amount of money that you have to take out of your account to pay for your expenses. And then the last transaction said that on March 21st, you pay the creditor for the purchase you made on March 6th. So if you remember, March 6th, the transaction for March 6th said that you purchased supplies on account for $50. So for this one, you paid your creditor, so you would debit your accounts payable account for $50 because you no longer owe that amount to your creditor, and you would credit your cash account for $50 because you're taking that amount out of your cash account to pay your creditor. Okay, so after doing each transaction, you would add up both sides. And then for cash, you get a total of $4,590, and that would be on the debit side of the T account because cash is an asset. So the balance, the beginning balance and the ending balance is always on the debit side of the T account. The same thing for accounts receivable and supplies. These are all also assets. So the total balance for each account would be on the debit side of the T account. So for accounts receivable, you get a total of $1,040. And then for supplies, you get a total of $130. Okay, and then for accounts payable, you you get a total of $970 on the credit side of the T account because it is a liability. And then for all your expenses accounts, each total would be on the debit side of your T account. So for wages, you get a total of $250. Delivery equipment expense, a total of $70. Utilities expense, you get a total of $55. And miscellaneous expense, you get a total of $85. Now the last two, for service revenue, you would get a credit total of $3,090. And then for capital, what you do for this is you would subtract your service revenue, any revenue that you have, your total revenue, minus your total expenses, and that would give you your net income. And so for net income, it increases your capital account, so you would end up putting it in on the credit side of the capital T account. So in this case, you have a total revenue amount of $3,090, and then you have a total expenses for $460. So you take the difference of that, and you get an amount of $2,630. And so because your revenue is more than your expenses, it would be a net income. So you would credit that to the capital account to increase your capital account. Okay, so I hope that you learned and understood everything that I taught you today. And I hope to see you next week on Simply Accounting.